Are you ready to crack CA? Let's make your dreams come true. Come and crack it with us.
Today, we're diving into the actual anatomy of business risk. We're going to start way up high, looking at those massive, headline-grabbing business failures you always hear about. And then, well, by the end of this, we'll drill all the way down into the precise mathematical ways that financial institutions measure those exact same risks. So if you're really focused on understanding why organizations survive or why they completely fail, you are definitely in the right place. Let's get into it.
I want to start us off with a massive paradox. How does a company that literally invented the digital camera, way back in 1975, by the way, end up going completely bankrupt because of that very invention? It sounds crazy, right?
That company, as you might have guessed, is Kodak. And their story just brilliantly highlights our first core concept. You see, Kodak actually built a digital camera. But when they looked at their own incredible invention, they basically just saw a threat to their core film business. So they actively chose to shelve it. They hid it away. And well, when competitors eventually launched their own digital cameras, Kodak was left totally in the dust and ultimately went bankrupt. The reason for this complete and total collapse actually has a specific name. It's called strategic risk.
So here's our roadmap for today. We'll start with 3 big internal risks: strategic, compliance, and operational. Then we'll cover 5 external financial risks, look at 3 completely different perspectives on risk, and finally, we'll dive right into the actual math of value at risk, or VAR.
All right, Section 1, strategic, compliance, and operational.
Okay, so these 3 represent broad, literally existential threats to a company's survival, and they mostly stem from the inside. Let's look at strategic risk first. This is the danger that a company's grand plan just stops working, usually because the world outside changes faster than the company does inside. You know, it's not necessarily about a company doing something inherently wrong. Actually, it's more about doing what used to be right for way too long, without even noticing the ground underneath them has completely shifted. It's kind of like a student who prepares perfectly for last year's exam pattern. If the exam board suddenly changes that pattern overnight and the student doesn't adapt, well, all that brilliant preparation is completely useless.
And honestly, we see this everywhere. Blockbuster built their entire empire around physical video rental stores. When streaming tech arrived, Netflix adapted their business model to fit it. Blockbuster didn't, and they completely collapsed. Same thing with Nokia, right? They failed to move fast enough into touchscreen technology, which gave Samsung the perfect opening to just swoop in and become the market leader. But hey, not everyone fails. Xerox actually adapted really quickly to laser printing. Amazon famously pivoted from just selling books to dominating massive e-commerce and cloud computing. The takeaway here: adaptation is absolutely the ultimate antidote to strategic risk.
Next up is compliance risk.
Imagine a company that successfully runs a cement business, and they decide, hey, let's venture into sugar manufacturing in an entirely different state. Now, the laws applying to sugar mills over there are going to be completely different from cement regulations. If the company fails to comply, and we're not talking about maliciously ignoring the rules here, but simply because they didn't know them or prepare for them, that's a massive threat. So compliance risk is really the danger of not even knowing the new rules exist when you step into a brand new arena. Our third internal risk is operational risk. Picture this. An employee is supposed to pay a vendor 10,000 rupees, but maybe they're tired. They accidentally hit an extra 0 on the keyboard, and boom, they pay 100,000 rupees instead. There's no massive calculated fraud happening here, no big external market threat. It's just a simple, incredibly frustrating human mistake. But guess what? It still costs the company real money. Operational risk is essentially the risk of things going wrong in the everyday, day-to-day running of the business simply due to people or processes failing. Moving on to Section 2, the 5 financial risks.
So now we're shifting gears from internal hiccups to external, market-driven conditions. Financial risk is all about unexpected changes in things like prices, rates, and credit. And it really breaks down into 5 main subtypes. First, counterparty risk. Basically, will the other guy actually do what they promised? Think back to Lehman Brothers defaulting in 2008. Second is political risk. This is adverse government action, like when Venezuela nationalized foreign oil assets back in the 2000s. Third, interest rate risk. This one hits banks heavily, and honestly, both fixed and floating rates carry risk, just in opposite directions. Fourth is currency risk. Say the rupee depreciates. An exporter like Infosys might gain, but an importer like Indian Oil is going to lose out. And finally, liquidity risk. This is just the inability to meet your liabilities because of bad timing, mismatches, or just not having adequate cash flow when you need it. Which brings us to Section 3, 3 perspectives on risk.
Identifying all those financial risks is great and all, but how they actually impact you? Well, that depends entirely on where you sit in the economy. Financial risk isn't just a single fixed thing. For instance, a stakeholder, like an equity shareholder, looks at high gearing, meaning high debt, as a major risk, because if the company winds up, shareholders are literally the last ones to get paid. The company itself, though, views risk from both sides of the balance sheet. Borrowing too much raises their own default risk, sure, but lending to a party that defaults also causes huge losses. And then, from the government's perspective, they're sweating about systemic risk. If a major institution like Lehman Brothers collapses, it spreads a massive wave of distrust across the entire financial system and can even trigger a sovereign debt crisis. It's the exact same risk, but viewed through 3 totally different lenses.
All right, Section 4, Understanding Value at Risk. Okay, we've talked quite a bit about qualitative risk theory so far, but now we're diving into the exact mathematical measurement of risk. Enter value at risk, or VAR. This concept was actually first applied way back in 1922, and today it's the world's most widely used measure of financial risk. Why? Because VAR answers exactly 2 critical questions for us. What is our absolute worst-case scenario, and what will the exact loss amount be? It basically takes vague, generalized anxiety and turns it into a precise, manageable rupee number.
There are 6 key features that really drive VAR. It needs a specific time horizon and a confidence level. It operates on normal distribution probability and relies heavily on standard deviation. It's absolutely the ultimate tool for risk control and asset and liability management, especially in the banking world. But the real engine, the thing that drives the whole calculation, that is the Z-score. Listen, if you're managing a portfolio, studying for an exam, or doing any of these calculations, I need you to memorize this specific number right now. 2.33. This is the Z-score for a 99% confidence level on a normal distribution table. Basically, it tells you exactly how many standard deviations a value lies from the mean, and it is the absolute key to calculating your VAR. Let's put it into practice. Section 5, Calculating Value at Risk.
So let's actually put this to the test. Let's say you're holding shares worth 2 crore rupees, and they have a daily standard deviation of 2%. What is your absolute maximum loss over one day at a 99% confidence level? Here we go. Step 1. Grab that Z-score we literally just memorized, 2.33. Step 2. Apply that 2% standard deviation to your 2 crore holding. 2% of 2 crore is 4 lakh rupees, right? That is your daily volatility in rupee terms. Step 3, just multiply that rupee volatility by your Z-score. 4 lakh times 2.33 equals 9.32 lakh rupees. So, at a 99% confidence level, your maximum expected one-day loss is 9.32 lakh rupees. Boom, done.
But wait, what if you need the 10-day VAR? Now here is the massive trap people constantly fall into, especially in exams. You do not just multiply that one-day loss by 10. No way. VAR actually scales with the square root of time, not time itself. So what you do is take the square root of 10 and you multiply that by a one-day loss of 9.32 lakh. Run that math and it gives you 29.47 lakh rupees. And there you have it. That is your true 10-day value at risk.
Of course, identifying and calculating all these financial risks, that's really only half the battle. Actively managing them is what's absolutely crucial for a business to actually survive. Whether that means doing intense due diligence to prevent counterparty defaults, setting really strict exposure limits, maybe sourcing materials locally to avoid political risk, or just obsessively monitoring economic data for interest and currency shifts, you have to proactively step up and mitigate these threats before they hit you.
Wow. Okay, we have covered an incredible amount of ground today, right? We went from Kodak's massive strategic failures all the way down to calculating the square root of time for value at risk. So as you reflect on how these invisible forces shape the businesses around us every single day, I want to leave you with this one thought. Out of all the financial risks out there, counterparty, political, interest rate, currency, and liquidity, which one worries you the most?
Thus.